for joining the class today. Today's topic is stock valuation. And let me also share another opportunity with you if you might be interested. I am thinking about offering a finance industry certification to my students. And I discussed this with the dean, and it seems like, he is willing to pay for the certification and any additional training that may be required. So whatever fee we may have, he is willing to pay for that. And I'm looking at some courses, some certifications that would be, somehow matching with what we have covered in this course and in your previous courses. And I'll be sharing some more information with you about that. It's totally up to you if you want to get on and receive that certification. It will require a little bit of extra work. We may have to design a new course. It's going to be a short course or something, and very specialized at the requirements for the certification. But when I was looking at the requirements, if you have done everything in this course and you understand what you have done and you can do the modeling in Excel, you will be pretty good to go through the certification exam. So just to bring that to your notice that you will hear some more information from me. And again, the university is paying for the certification fees, whatever that may be, and also for the additional, boot camp or whatever we may call it, for that additional training. So the university is paying for it, and the payment is coming from a recent grant that we received from JP Morgan Chase. So I think that's a good opportunity for you. Please keep looking for additional information from my side. And now coming to the topic, stock valuation.
So quick question. What would the certification say? It would say just in.
Okay, good question. So, like we have different industry certifications in the field of finance. For example, we have the CFA, and we have a CPA and the accounting side. And there are some other certifications as well. CFA is quite tough and difficult. That requires a lot of work. But I'm looking for something that, could be quite easy for you to go through based upon your learning in this course. So I would say, like, if you are 100% confident about your learning, whatever you learned, and you've gone through the resources and the exams and the quizzes and everything, and you're like 90% confident about your capabilities, then you would be good to take that particular certification. It's not going to be the CFA, but something similar.
Okay. All right. Okay. Thank you.
All right. You're welcome. All right. So now coming to the topic, stock valuation. We know that, a firm can raise capital from different sources. One of the sources is to borrow the money from the market. From financial institutions or from individuals through bonds or whatever other sources. And that is a liability and has to be repaid. The company uses that money to buy assets, and then the assets are used to generate profits and do the business and conduct the operations. The other source of funding is stock, which is the equity contributed by the owners towards the business. And the owners, those stockholders, are actually the real residual owners of the company. Okay, they also bear the residual, responsibility in the losses as well. So, for example, if the company goes bankrupt and there's nothing left for the stockholders, common stockholders, they will not be paid anything, even though their liability is limited to their investment. Bondholders receive a priority in payment, so they're paid first, and then preferred stockholders and then common stockholders are paid at the end. So the shares that you talk about in the market, like we say, like, Tesla's price is going up, and Microsoft and Google and all of that is what we when we talk about those things, those are the common stocks of those companies. When you buy those stocks, you become a partial owner of the company. Now, those prices are going up and down, sometimes based on speculation, they're going up and going down. But what we need to do is to find the intrinsic value of the stock. And the intrinsic value is actually what we call the true value of the stock. And this true value is basically it depends on the benefits that the stock will generate for you in the future if you buy it. And those benefits, of course, are the cash flows that you can receive. Okay, and there are different models that we can use for finding that intrinsic value. So this chapter is in particular, for particularly focus on finding the intrinsic value of the stocks. All right, we'll be using a number of models that we're going to talk about in the next few slides. When you buy the stock of a company, you become a partial owner of that company. And it implies that you have partial control. But I mean, like, if you buy 100 or even like 500 or 1,000 shares in Tesla, that does not give you significant control because you are still a very minor, very small stockholders, and your shares would not be having a significant vote. But if you like hold 10, 15% or 5% even of the stock, then you can have control. You will have a say in the board and all of those things. And if you become a member of the board of directors based on the number of shares that you hold, then you will have a say in selecting or electing the management, and you can have your voting rights. Of course, even if you have just one share, you still have the voting right, but the control would not be that significant. But if you become a member of the board of directors, then you will have more control. The goal of the firm's management, and this is what you must have learned in your previous finance classes, is to maximize stockholders' wealth. And one of the key measures of stockholders' wealth is the stock price. So if the stock price goes up, the stockholders' wealth is maximized, it's increased. If it goes down for whatever reason, there's a bad news about the company, the earnings targets are not met, or maybe subscribers are going down, then the stock price goes down immediately, and the stockholders or the owner's wealth is decreased. So the management's goal is to maximize stock price, and by doing so, they are increasing shareholders' wealth. Okay. Now, when we talk about finding the intrinsic value, that's just what I told you a while ago, but this is basically the value of the future benefits of the stock. There are a number of models that we can use. One of the key models that we use is discounted dividend models. Okay, here what we do is that we look at the future dividends of the stock. And because the dividend is the actual cash inflow to the stockholders, then we use those future cash flows and find their present value actually. So it's the same present value concept that we learned in chapter 5. So in this case, we'll be finding the present value of the future dividends, if we consider that to be the only benefit that we receive from holding the stock. But sometimes, some companies, even they might be performing really well, but they don't pay any dividends, or the dividends are not predictable. In that case, we use a variation of the model, which is called the discounted cash flows model. So the model is basically the same, but instead of dividends, we use the cash flows of the business. And then there are some market multiples like price earning ratio or price to sales ratio. Those can also be used to find the value of a stock. So we'll start with the discounted dividend models. And as I said, this is basically the time value of money concept. Now just imagine if you buy the stock of a company and and you hold it forever, and this stock pays a dividend. Now, what is the benefit that you receive if you become the owner? You will be receiving D1, which is going to be the next dividend of the stock. D0 is the current dividend that has already been paid. But if you become an owner right now, you will be receiving the next dividend, which is going to be the D1. So we find its present value, we discount it to the present, and you can see we divide it by the 1 plus R raised to the power 1. So discounted for 1 year because we'll receive D1 in 1 year. D2, which will be the next dividend, will be received in 2 years, and we discount that for 2 years, and D3 is discounted for 3 years, and that goes forever. You know, so what we need to do is to find this total present value, and that would be the intrinsic value of the stock. That would be the intrinsic value of the stock. Now, what do we do with the intrinsic value? Let's say that you found the intrinsic value of a stock, and that is $10. If the stock is currently sold in the market at $8, for example, then that means the stock is undervalued because the true value or the intrinsic value is $10 and it is being sold at $8 in the market. So it might be a good buy. But if the stock is being sold in the market at the market price is $15, in that case, we can say that this stock is overpriced and this is not a good time to buy it. So we use this intrinsic value in order to take those investment decisions. Now, here's an example. If there's a company and that pays a constant dividend. So this model, there are different variations. If the dividend is constant, then we call it the constant dividend model. So let's say that it pays $2 dividend and that dividend goes forever. We look at the past history of the company and it has always paid $2 dividend per share, and it's going to continue the same policy. We can read the annual reports and the company's other announcements, but as far as we know, that dividend is going to continue. And the discount rate that we can use for its equity is 9%. So that would be the discount rate that we use for finding the present value. Now, if it pays $2 dividend forever, okay, that means it's a perpetuity. And we have learned the formula of a perpetuity, finding the present value of a perpetuity. That is actually the payment divided by the discount rate. So PMT, now what is the payment here? The payment is the dividend that you will receive in the future. That's the same dividend and it goes forever. Perpetuity formula becomes P is equal to the price, or the intrinsic value is equal to the payment divided by the discount rate, and that comes out to be $22.22. That means this stock's intrinsic value is $22. If it is being sold at $15, it would be a good buy. But you'll also have to look into a number of other variables as well. Okay, but then, there are some companies whose dividend grows at a constant rate. They have a policy that the dividend grows at a constant rate. And let's assume that the dividend grows with that constant rate forever. In that case, the model becomes slightly different. The intrinsic value would be equal to the D0, which is the current dividend that has already been paid, multiplied by 1 plus G. This G is the constant growth of the stock, and divided by RS minus G. RS is the discount rate of the stock, or the cost of equity, we can call it, and G is the growth rate of the stock. Now, we also know that if we multiply D0 with 1 plus G, that means that will be the next dividend. So we can say that is D1. If we multiply D1 with 1 plus G, that would be the D2. And if we multiply D2 with 1 plus G, that would be the D3. So we can simply write the formula as P0, the intrinsic value, would be equal to D1. Remember, D1 is the next dividend, and divided by RS minus G, where RS is the cost of equity and G is the growth rate. And that is the constant growth rate. Okay. What will happen? Just to talk about, what if the growth rate is greater than RS? If G is greater than our RS, What do you think will happen to this stock, this model? No response?
Well, it can't happen, I think, because it would make no sense. It will be negative number.
Correct. Absolutely, absolutely. In that case, the intrinsic value will become negative, which does not make sense. And what if RS and G are equal? In that case, this number will be zero in the denominator, and something divided by zero becomes an undefined number. So it does not work if G is equal to R or G is greater than R. In that case, the model will not work. It works only when G is less than the cost of equity. All right. So that is what that discussion is all about. Now, in the next few slides, if you, if in some problems, if you are not given, if RS is not given to you, then you will have to use. Remember, you'll have to use this formula to find its RS, and we have learned this formula in the previous chapters. RS is equal to RRF, which is the risk-free rate and government securities, plus RM, the market return, minus RRF multiplied by beta, which is the beta of the company. All right, now let's hold on to this discussion and jump on to solve a few problems based on this. The chapter is pretty easy, no big deal. So here we've got a problem. Find the price of a stock if it just paid $2 dividend. So if it just paid $2 dividend, that means it is the D0. It is the current dividend, and which is expected to grow at a constant rate of 4%. So that is the constant growth model we're going to use. And the cost of equity is 9%. So we just pull that information out. The current dividend, I misspelled it, not dividend, it is dividend, right? D0, let's call that D0, it is $2. The constant growth, let's call that G, and it is 4%. And the cost of equity, let's call that R or RS, and that is 9%. There are a few things that we can answer based on this. We can find the current price of the stock, okay, using the constant growth model, this one. Then we can also, if required, we can also calculate the next year's price. Okay, that would be P1, the price 1 year from now. Even if they ask you to find the price of, the stock 5 years from now, we can do that as well. We can also find the current dividend yield, let's call that dy, and we can calculate the capital gains yield from the given calculations and information, and then we can also calculate the total return. And the total return in terms of percentage should be equal to the cost of equity, which is 9%. Okay, now let's start it. Using this model, the current price or intrinsic value should be equal to, we're given D0, right? So let's start with D0, which is $2, and that is multiplied with, we start the parentheses, just follow this formula with me, 1 plus G. So that would be 1 uh, plus G, and growth is 4% right here with us. We close the parentheses and then divide RS minus G. Now do remember that we need to start the parentheses here if you're doing these calculations in Excel, because the thing is that this difference has to be found first, and then we do the division. Okay, so we start the parentheses. So that would be RS 9% minus G, which is 4%, and we close the parentheses and press enter. We get the price is $41.6. So this should be the intrinsic value of this stock if it pays $2 dividend, and that dividend grows at 4% forever. And this company's required rate of return on equity is 9%. what would be the price 1 year from now? Now the price grows at the same rate as this dividend growth. Okay, so that is a simple formula. In that case, the next year's price would be equal to the current price and multiplied by 1 plus G. Multiplied by 1 plus G. It is the same concept like we used when we calculate the future value. What would be the future value after 1 year? So we do it 1 plus I. In this case, that I, the growth rate is this one. So we use that 4% growth rate. So the next year's price would be, is estimated to be 43.26. So that is estimated. Now, just imagine if it asks you to find the price after 5 years. What would be the price after 5 years? That would be equal to the current price multiplied by, we start the parentheses, 1 plus the growth rate, which is 4%, and raised to the power 5. So we raise it to the power 5 because that's like, exact formula that we use for finding the future value. If you do that, price 5 years from now would be 50.16. Okay, but that is not asked right here. We're only asked to find the price after 1 year. Now, what is the current dividend yield? Remember, this is the same concept that we talked about in when we were discussing the bond's yield, bond's current yield. What did we do in that case? The current yield of the bond was the interest payment in that particular year and divided by the price that we paid for the bond. That was the current yield. The same concept here. What is the dividend that we receive in the current year? That is $2. Okay, and divided by the price right now. So the price is 41.6 and the dividend yield is 4.6, 4.8. Okay, so here's the thing. We need to consider the next dividend, not the current dividend. That is what we are going to receive. So the next dividend, so we'll have to divide the next dividend. The next dividend would, of course, be equal to the current dividend multiplied by 1 plus G. 1 plus G, which is the growth rate, and then we divide it by the current price. So it comes out to be 5%. I hope that makes sense, because the concept is that when we pay this price right now, 41.6 for this stock, we will be receiving the next dividend, not the current one, which has already been paid. So the current yield is 5%. What is the capital gains yield? We know that capital gains yield is actually the percentage return that we receive as a result of the price appreciation. And we know that the price is expected to appreciate here from 41.6 to 43.26. So we can do that process. What we need to do is to find the difference in price, the change in price. So that would be 43 minus 43.26 minus 41.6, close the parentheses, and divided by the current price. Okay, so that comes out to be 4%. So we will be earning 4% as a result of the price increase in the stock in 1 year. What would be the total return? Total return would be equal to the current yield, current dividend yield, and plus the capital gains yield, which is 4%, and that comes out to be 9%. So this 9% is the same return as we expect from this equity. That is the cost of equity. And we would be investing in this stock if it gives us our required rate of return or higher. Any question? Okay. Seems all good. Let me see, there's a comment or something. All right, okay, so many people have joined. Thank you for joining. And we have Ali, Williams, Emin, Mitra, Lakita, and Anthony, Susan, Veronica, and Samir. That's it for now. Somebody's waiting in the lobby, I think. Okay, all good. All right, now the next problem, and it's going to be quite interesting right here. Okay, I need your attention because you can expect similar questions in your exam. Here's a situation. It's the same stock as we have above. It just paid $2 dividend. The growth rate is 4%, and the cost of equity is 9%. But the thing is that the growth is not constant. The growth becomes constant from year 3 onwards. So that is what has been given to us. Until that point, the dividend growth is different. For example, in year 1, the dividend grows at 30%. In year 2, it grows at 20%. In year 3, it goes at 10%. And then from that point onward, it starts to grow at a constant rate of 4% forever. Let me see, somebody is joining. All good here. Okay. So in this case, what we need to do is if these growths are not the same, then the discount dividend discount model cannot be used until the point where the growth is different. We can apply the dividend discount model from the point where it becomes constant, and which is here, right here. From this point onward, the growth becomes 4%. So from year 3 to year 4 to year 5, that is a constant growth of 4%. Now, if we apply the dividend discount model, it will be applied only to these cash flows, not to the previous ones. And this will find the price at this point in time, right here at time 3, because we are applying the model from this point onward. So it will discount those future cash flows to this point, to year 3. Okay. But until that point, let's see what dividend we have here. In time 0, it just paid $2 dividend. The next dividend would be equal to, let me delete all of this. Okay, the next dividend would be equal to the previous dividend multiplied by parenthesis start 1 plus g, which is the growth rate. And that growth rate in this particular year is 30%. So it grows at 30%. The next dividend that is going to be 2.6 because it grows at 30%. And then we can drag it to the right. So it applies the 20% growth rate to the next dividend. Okay. And then so on. And you can go on to whatever point you want to, but from that point onward, it grows forever. So we actually don't need that much of information. I think we're good until this point where we have the V4, because we can use this dividend discount model to find the present value at this point of the future dividend cash flows. But these values will have to be discounted separately. Now, we know that year 1's dividend, which we'll receive, is 2.6. Year 2's dividend, 3.12. That will also receive that one. And year 3's dividend and year 4 dividend. But from that point onward, this is going to grow at a constant rate. So we can apply the this model right here, this model, to find the value of this stock. And that would be called the terminal value of the future dividends. So that would be equal to, we can apply this formula, the next dividend, D1. D1 is the next dividend. And what is the next dividend from this point onward? The next dividend is the dividend of year 4. Okay, and divided by, we start the parenthesis and then RS minus G. RS, which is the discount rate, I think that is coming from the previous problem. We can use that one. Minus G. G is the growth rate, the constant growth rate, remember. and we're good to go. So the value of those future dividends is $71.39. What is the total cash flows? Well, this $2 is not our cash flow because we don't receive it. It has already been paid. We will receive this dividend, and plus if there's any additional cash flow over here, we can add that. But this is going to be the cash flow. Right here in the last year, it is adding the dividend plus the terminal value of the future dividends. Okay, so that comes out to be $75. What would be the total present value? Uh, so we now we need to find the present values because these are not the present values. These values are in the future. Okay, so we can apply the present value formula equals to. We know the present value formula is. Let me write that down. Present value formula PV is equal to FV divided by parenthesis 1 plus R raised to the power N. Okay, so we can apply that formula equals to future value. The future value in this case is $3 divided by, we start the parenthesis, 1 plus the discount rate, and the discount rate is 9%, raised to the power the number of years, raised to the power the number of years. So we will be discounted this for year one, for 1 year. Okay. One more thing that we need to do is, because we'll be dragging this formula, so that return or the discount rate has to be fixed. It should not change. So I put that $sign with that with the discount rate so that when we drag it to the right, it will not change the reference. So these are the present values. You can see this is the present value of $3 discounted for 2 years for 9%. Okay. And this is the present value of $75 discounted for 3 years at 9%. What will be the total present value? That total present value will be actually the intrinsic value or the price that we should pay for this stock. So equals to, that would be the sum of these present values of the future benefits. Any question at this point? All good? Okay. So now the next question. If the stock was expected to have a negative growth, well, the stock dividend has a negative growth. So what that means, the company is still paying dividend, but the dividend growth is negative, which means that it is reducing the dividend. The next dividend is going to be less than the current dividend. In that case, the model still works, but because the dividend is decreasing, the stock price would be smaller. So we will use the same model as we have over there. It doesn't matter what happens to those variables. Is there any question? All right, nothing. So equals to, we use this formula, D0 into 1 plus G. So D0 is $2 multiplied by parenthesis start 1 plus G growth rate, which is minus 4% here. And we close the parenthesis divided by, again, parenthesis start, RS minus G. So RS is 9% and minus G is 4%. So that minus and minus becomes a plus actually. That's why it's good, will give us a smaller value. So the price in that case would be 14.77%. Okay, we can see from the first problem when the only difference in this problem and with the negative growth is that the growth is negative. Otherwise, the variables are the same. So if the growth is plus 4%, the price would be $41.6. But if the growth is minus 4%, then we will be happy to pay only $14.77 for this stock. Okay, now the last question and the last concept that we're going to cover. So let me go to the PowerPoints for a minute so that we can talk about the model. So now that is what we discussed. This is the problem that we just solved in Excel. And if you want to do it with your pen and paper or your calculator, it's the same thing that you do here. D1 would be equals to D0 into 1 plus G. So that comes out to be $2.08. And then you do the division. D1 divided by RS minus G. You get exactly the same answer as we got in Excel. So if you are more of like, calculator friendly, you can use this. Okay. If you are required to find the future, the next price, so one of the ways is to find the D2 and then apply the formula. But the simplest method that I told you to find the next year's price is to simply multiply the growth rate to this initial price. So what I did simply was to grow this price, this multiplied by 1 plus the growth rate, which is 4%. And that is quite simple as compared to the other one. Otherwise, you can find D2, okay, and then apply the formula. Because in that case, for the next year, D2 would be this D1 that we apply in the formula. Okay, so if you want to do it that way, it would be this. D2 is 2.1632, and then you divide it by RS minus G, it comes out to be 43.26, which is exactly the same that we got here in Excel with the simpler method. Okay, here's the dividend yield, the current dividend yield. So that would be the dividend that we will receive divided by the price that we paid. Okay, that comes out to be 5%. Same thing that we did. Capital gains yield would be the difference, the change in price divided by the price that we paid for it. So that comes out to be 4%. Total return would be the dividend yield plus the capital gains yield, and that comes out to be 9%. So this is all that we did already. Supernormal growth, we also did that problem right there in Excel. And if you want to just break it down, graphically, this is how it looks. So D0 is the current dividend that has been paid. In the first year, it grows for 30%. Second year grows for 20%, and then in third year it grows for 10%. And then from that point onward, the growth becomes constant. So applying this growth to the dividend, the next year's dividend would be 2.6, and then 3.12, and then 3.432, and then that grows on and on. So what we're going to do is to apply this. This is going to be the next dividend. We apply the constant growth model to this point. So that will bring the future cash flows to this point, and then we find the present values of all of these cash flows and sum them up in order to get the total price of the stock. But I think that illustration in Excel was a bit more easier to go through and understand. All right. If the stock price, if the growth rate is negative, then again, we did that problem as well. No issue with that. Now, the last concept is what we call the corporate valuation model. Now, this model is more useful where either the company does not pay dividend or the dividend is not predictable. So they decided right at the last minute what dividend they pay. So it is neither constant, it doesn't grow at a constant rate or something like that. So in that case, it would be good to look at the cash flows and non-operating assets and the uh, debt, preferred stock and debt of the company to find the company's market value. Now, this corporate valuation model is often used when one company wants to acquire another company. So this is primarily in the used in mergers and acquisitions. Now, what we do in order to find the market value of equity of a company, and remember, equity is the shareholders, the owner's interest in the business. In order to find the market value, remember the book value of equity is already given in the balance sheet. We're not talking about that. We're talking about the market value of equity. So what we need to do is to find the market value of the company's operations. And operations actually result in free cash flows right here. So we'll have to find the free cash flows, future estimated free cash flows, and then we will find their present value using the same model like we did in the dividend discount model. And then we add the market value of non-operating assets. So non-operating assets would be those long-term assets that we have that are not directly used in the operations. And then we subtract the market value of debt and preferred stock, because debt and preferred stock are sort of liabilities that have to be paid. Or preferred stock is not paid, but it's still, like, not considered as part uh, of the equity. So we have to remove that in order to find the market value of equity. So a couple of things that we need to know. The market value of equity, this would be either given to you in the problem, so it's not a big deal. Market value of non-operating assets, you can get this from the balance sheet. Also, you can get these two numbers from the balance sheet as well, or they would be given to you in the problem. So no big deal for that. The difficult thing here is to find the market value of operations. So we'll have to estimate the future cash flows and then find their present values. Now, how do we find the free cash flows? And do remember that this free cash flows this concept is used in your next case study as well. Okay, so when you do your next case study, you'll be applying this concept. So free cash flows are equal to the EBIT, which is the operating profit. But then we multiply that with 1 minus T, because we want this operating profit to be after taxes, so that we know what are we going to get, right? Because you'll have to pay the taxes out. So EBIT, earnings before interest and taxes. And then we also add the depreciation and amortization. Reason being that depreciation and amortization is non-cash expense, even though when we were calculating the EBIT, we removed depreciation and amortization for tax purposes because we get a tax benefit. But then we added back to the calculations because it was a non-cash expense. So we didn't pay any cash. It did not reduce our cash, so we added back. And then we subtract the capital expenditures, whatever we have spent, any additional amount that we have spent on capital expenditure, like, buying some long-term assets, any additional money spent on that. And also the change in net operating working capital. If you can recall this, the change in net operating working capital or the net operating working capital is our investment in the business. So the change in net operating working capital is our additional investment in the operating assets. So these two numbers, these two actually reduce our cash flows. That's why we sum them up and remove it from this number so that we can get the free cash flows. So you'll be using this concept in your group case study 2. All right. Now, then it becomes easier. We'll get these numbers, and then in order to find the present value of the operations, we will have to estimate all the future cash flows and then find their present value. All right, so that's the same explanation. We'll find the horizon value. Here's the thing, a question on that. Imagine that there's a company and we expect the free cash flows to be -5. This would be -5 million or billion, whatever you may call it. And this is estimated to be -5. Okay, in year 1. In year 2, we will receive a positive cash flow of 10 million, and year 3, we'll receive 20. And then after that, the cash flows will become constant growth. So it grows at 5%, and that goes forever. Now here, what we need to do is we can apply the dividend discount model, because even though the cash flows are different, but the concept is the same. Just imagine as if these are dividends. Instead of dividends, these are just cash flows. So we apply the same concept right here. So we will find the present value of this -5 discounted for 1 year at 7%. This 10 will be discounted for 2 years at 7%. And remember that we use the WACC here as a discount rate. WACC is actually the weighted average cost of capital. Reason being that weighted average cost includes the cost of debt and the cost of equity, and we find the weighted average. We have a separate chapter on this. We'll be talking about those in more detail. But right now, this is basically the discount rate that we use for this problem. And then at this point, we apply the dividend discount model to find the value of the future cash flows at this point, at time 3. And here in this case, we call that the horizon value. Horizon value at time 3 is equal to the next cash flow, which is 21 divided by RS minus G. All right, so that will give us the, if we sum these numbers up, that will give us the total present value of the company's operations, present value of operations. Now, in order to find the market value of equity, we got the market value of operations. This number would be given to us, and that number would also be given to us. So we simply sum them up and find the answer. Okay, let's jump onto Excel and do the same problem in Excel. Here you go. This is the company, the same problem. A firm has the following cash flows as given in the table. So these are the cash flows: -5 in year 1, 10 in year 2, 20 in year 3, and then we can find that one by applying the growth rate of constant growth rate of 5%. Its cash flows will grow at constant rate of 5% beyond year 3. So that number is not given to us, but we can, apply the model equals to this cash flow multiplied by bracket start 1 plus the growth rate, which is 5% right here. We close the parentheses, and that would be the next cash flow. Okay. All right. Now, let's find the horizon value at this point of the future cash flows applying this formula. Okay, so let me copy that from there, Control C, so that we can see it here. Okay. And it will give us the horizon value of the future cash flows. So that would be equal to the next cash flow, which is D1 in our formula concept, divided by bracket start RS minus G. So RS is 7%. Here in this case, we use the weighted average cost of capital minus G, which is 5%. We close the parentheses, and that gives us 1,050. If these numbers are in millions, so that is $1,050 million. Okay. What will be the total cash flows? The total cash flow would be equal to, of course, this number, plus if we have any number right here. So in year 3, we'll be receiving the $20 million cash flow plus the $1050 million, which is the horizon value of the future cash flows. What is the present value of these cash flows? Of course, we will use the present value formula. So equal to, we can also use the Excel's present value function if you want to. We use the rate, which is the discount rate, 7%. And remember, we need to fix that. So the dollar signs, don't forget that. And number of periods. So we will be discounting this cash flow for 1 year, comma, payment. This is not an annuity, so that payment would be 0. And future value is this value that we use. And this is an ordinary annuity, so you can ignore the type or give it type 0. So that comes out to be 4.7, and we can drag it to the right. Okay. All right, so what is the total present value of future cash flow? That is equal to the sum of these cash flow. Okay, one thing that we need to know, Excel by default, the function made these values negative because we are giving. So let's if we're using the Excel function, let's go to the future value and put a negative right there so that okay, something is wrong. Okay, let's drag it to the right. All right, now that's good now. Okay, so this is the total present value of the future cash flows. Okay, now what is the market value of the equity? What is the market value of the equity? Look at this formula. Market value of the equity would be equal to market value of operations. And you can also call this, let me write that in bracket, or market value of operations. Okay, so the formula is market value of equity is market value of operations plus the market value of non-operating assets. That number is given to us. The market value of non-operating assets, 5 million. Okay, minus the market value of debt and preferred stock that is given to us is 40. So let's do that. Market value of equity would be equal to the market value for operations, which is 877.5, and then plus the market value of non-operating assets, which is 5, and minus the market value of debt and preferred stock, that is 40. So this is debt and all right. And what will be the value per share? We know the number of shares are 10 million because all of these numbers are in million. So we simply use that 10 number. So we take the total equity and divide it by the number of shares of common stock. So that would be $84.25 per share. So if we have to buy this company, we would be good if we pay a price of $84.25 per share to this company's shareholders. All right, so I think that's it for today. These problems actually also cover all of your assignments problems. So if you have any problem in the assignments, you can also check that. And for the case study 2, by the way, I think I have posted some videos, but if not, I will post it. But I'm available to discuss the case study with any group that has challenges and is unable to find some of the things. Okay. Any question?
Thank you.
No questions. Thank you.
All right. Okay.
Thank
Sounds
you,
good.
Professor.
You're welcome. Thank you for joining the class today. I appreciate your time and I appreciate your willingness to change the time with me.
So, Professor, Group 11 will be setting up some time with you. We had a couple of questions once we met about the project too. Okay.
Of course, always available. Just send me an invite and let's decide a time and I'll be happy to help.
Okay. Thank you.
All right. You're welcome. Take care and have a good night.
You too.
Thank you.
All
You
right.
too.
You're welcome.